What's going on, everybody? It's Ryan here. Today, we're going to talk about what it takes to be a successful investor. I had this topic on my mind, been listening to a lot of Warren Buffett videos, if you ever watched the Berkshire Hathaway meeting videos, and they got me thinking a lot because it's a topic that I think about a lot. I like to invest in the stock market and businesses and media and different sorts of things, and I thought I'd try to open up a conversation on this. So if you're interested in learning how to make more money, put money to work with very little effort, or without physical effort, I should say, lots of mental effort probably, continue watching and you're going to learn more. So if there's one thing that I do want to talk about, it's that there are really three main things that I think about when it comes to being a successful investor. Number one is interested. You have to be interested in whatever you're investing in. And it sounds kind of obvious, but I think a lot of the time, people want to get into the stock market. People want to get into maybe, I'm in online marketing. People want to get into online business, e-commerce, media buying, copywriting, flipping houses. I think the fact remains, even if you do make a lot of money, if you don't find it interesting, you're just not going to do the work necessary to keep going. Because the truth is, if you're really interested in something, you're just going to keep going because it's basically more than half of it doesn't feel like work. Number two, I wrote down here is mitigate risk. This is probably one of those tried and true principles, which is that there's this old saying, it's pretty consistent, is that if as long as you take care of the downside, the upside takes care of itself. Really a lot of what investing is really not losing money. I think Warren Buffett's favorite quotes is, or one of his quotes that he's used that you hear a lot is, rule number one, don't lose money. And number two, refer to rule number one. So don't lose money. The thing I find interesting about Warren Buffett is that he's a very smart man who knows what he's doing, but he comes across as this sort of like kind of tongue-in-cheek, nonchalant, goofy dude sometimes. Anyway, so that's number two, which is mitigate risk. And the last thing is a circle of competence. You got to know what you are investing in. So if you don't know what you're investing in, you're pretty much gambling. And that's the thing that you want to reduce. Because the thing is a certainty, right? Because certainty is ultimately what we pay for. Because generally, the more certain a investment is, the more certain people know of a particular outcome of something, the lower the returns will be, generally speaking. The less certain, when there's more uncertainty, typically the returns will be higher. And maybe not necessarily higher, but definitely more volatile. And that's one of the things that you want to think about when it comes to investing. So those three things, again, repeating is number one, be interested. Number two, mitigate risk. Number three, circle of competence. So you have those three things down. So what's next? How do we get to that next stage of investing? How do we take these three things and become a successful investor? I think what I'm going to do in this video is I'm going to talk more about the third thing, which is circle of competence. When you really know and understand something and you really understand a particular niche, market, business, the likelihood of you losing money is low, or there's a very low probability. You'll make more money. You'll be able to leverage money because you understand the vertical or the niche. And I'm mentioning this now, and why I want to put a lot of focus in this particular thing is because often you invest in what you know. And if you want to know more about it, you spend more time in it. Because that's the thing. People who become successful over time have spent a lot of time. And if necessarily, maybe not, like here's a good example, like Mark Zuckerberg, right? Created Facebook, multi-billion-dollar company. And how did that happen? Well, he learned how to code, right? And then he learned about what college campuses are interested in. He was a college student. If you watch The Social Network, although it's sensationalized, he knew his market, right? They started off by going to colleges and they went to different colleges before they branched out into, to the general public. So his circle of competence was programming and colleges, and then knowing what people were interested in. And mostly for Facebook or social media at the time, because at the time when Facebook came out, I think the most popular thing was Friendster. You think about these things, people were interested in people's relationship status. So knowing that, I think it started off as the book face or something, or I forgot what it was called, the original name was, or maybe the Facebook, I can't remember. But the point is like he knew his market, he spent time in his market and an intense period of time understanding programming and then also knowing what people wanted. And then, of course, he partnered with people that had better networking skills, that sort of thing. So you got to think about, like, what is it that you already know? What is it that you really already understand? One of the things I find interesting is when I talk to people about investing is when we talk about the stocks. And the interesting thing about stocks, the more I trade stocks, the more I invest in stocks, the more I realize how stupid I am and how I really don't understand much. Some people will say, well, I think that Tesla is going to go have self-driving, right? Or something like that. They're going to have self-driving and then they're going to they're going to compete with Uber, right? And it sounds like a really great thing, right? But I heard that from somebody else on YouTube, someone else much smarter, and maybe their advice is good. But how much time does a person spend really researching and really understanding it. And even then, even if you spend all this time, I mean, how well do you really know it? So that's kind of the things that I sort of think about when it comes to investing, is just like, how well do you really understand and know something? Because after you understand and know something really well, you have to take a look at the next step. And that next step is probability, because you have your circle of competence, you know something. So what's the probability of a positive outcome? And that's ultimately comes down to circle of competence. Like if you know the likelihood that it's going to rain, right? You look at the weather report, or in a particular business, you know the likelihood that the stock is going to go down. See, the thing is, like, as you become more deeply entrenched in understanding, a particular niche or your circle of competence, is just take a look at stocks. Like, I don't have a lot of fundamental analysis in stocks. Like, I don't really read like balance sheets or annual reports or anything, but I know technical analysis pretty well. And I know what happens during earnings period, or leading a week or 2 or 3 weeks leading up to earnings period, the stock tends to get really tight. It tends to trade in a very tight range. And then that causes the volatility to sort of like, has a probability of like a winding spring. So what this I'm describing to you is pattern recognition. So that means as you get closer to earnings, what happens is you're going to either have a break on the upside or the downside, depending on how volatile the stock already is, simply because of just the way behavior is. Because as people are expecting certain kinds of earnings, and if they have surprise earnings, it's going to surprise positive earnings and it's going to go up, or surprise negative earnings is going to go down. And sometimes it can move pretty wildly. And those are the things that I think about, is those fine-tuned probabilities of what's going to happen. So when it comes to a business or your area of expertise or whatever it is that you're learning, it's kind of understanding those probabilities. Because the thing that I think about too when it comes to stock trading or investing is that right now, as of this recording, it's January 14th as I make this video, the Facebook and Twitter are getting hit pretty hard. They're getting hit pretty hard because I think Donald Trump came off of, they kicked them off of Twitter. So what happened was a particular politician came off of Twitter, right? And I'm not going to say his name because I think it might affect my algorithm and get me negative results. So what's going to happen is they kicked them off, and what ended up happening was it caused the stock to go down. That's like one of the main reasons why they're being affected, because this particular politician generates a lot of eyeballs to the platform. So when you kick them off, you're just to have less eyeballs on the platform. So a lot of people are pricing in that Facebook, Twitter, all that kind of stuff is going to get less earnings because there's less people gravitated towards there. So you think about that for a moment. The stock of Facebook and Twitter are going down. So we're going to take a look at some stocks here. Take a look at a chart of Twitter and Facebook, and we can take a look at kind of what's happening here. So you can see, like, we look at Twitter, and let me just pull this chart up. Let me also pull up Facebook, because they kind of follow each other anyway, because they're in the same thing here. Same kind of, they're looked upon the same thing. So you take a look at this stock here, and you kind of see how it's been trading downwards for a couple days now. But you take a look at so the question is, why am I bringing this up? Because I'm buying some of this stock. And one of the reasons why is because you can see that there's a pretty solid resistance line, or support line right here, and it's going to fill this gap right here, right? Actually, what it did, right? So it's going to fill this. So there's solid support here. So it's a good place to kind of buy if I want to get in for a trade, because it might bounce off of this position. I mean, it can break down, but the probability is low, right? The Warren Buffett quote is like, be greedy when others are fearful, right? But because I'm not necessarily an expert at this, I'm not a professional, and I'm just sort of learning and kind of playing around, getting a good understanding of things, and basically practicing with real money, is that it's not high conviction, right? It's just more like I'm seeing this observation here, right? And I'm thinking, okay, well, this is what I think is going to happen here. This support line, I think I'm going to go ahead and I'm going to go ahead and just bet on this, right? I'm going to go ahead and just bet on this little potential bounce, right? Same thing with Twitter here, right? So Twitter, same thing. It gapped down here, and then now you can see there's like a decent amount of there's some support in this section here, but it actually looks like it will might have like if I waited for it to go down to here, maybe, right? Probably a better chance, but you could miss that too. Right. So you just kind of have to think about what your probability of catching something is. And then also another thing to consider here is like when is earnings, right? So FB earnings 2021, and we have it is on January 27th. So we're having January 27th. So maybe the stock gets beat up, and then in about 14 days or so, the stock may pop up because they might have better than expected earnings. So that's kind of what I'm betting on. I'm not necessarily betting on positive earnings because that's just a 50-50. I want to get like at least a 60% edge, or at least in my mind, that is what I want. And that's ultimately what I'm looking for when it comes to investing, whether it be, but see, again, I know I'm talking about stocks, I'm talking about trading and not necessarily long-term investing, but I look at a lot of things in this kind of way, right? It's being able to like look at the probabilities of like what may happen. And then so that's pretty much it, right? And again, since I always have this chart here, I might as well just pull up Tesla because that's always my favorite stock to look at because it's just so interesting of a stock, and I love the company. So you can see how we got earnings coming up. I think on February. I think. Let's go see here at TSLA. February 3rd, right? So it's going to probably like wind up and stay in this tight range until earnings. It's really extended, so I think that there's just a lot of risk to be in the stock. And I actually had a small position in it that I sold about 2/3 or I think 3/4 of, right, just to get more in cash, hoping that the stocks will take a hit during earnings season, but we'll find out. So you never really know. So anyways, that is sort of like my thoughts on like becoming a successful investor is those three things: be interested, manage risk, and then, of course, circle of competence. I spent most of my time talking about circle of competence and then using an example with the stocks. Anyways, I hope you enjoyed this video. If you have a comment or you want to make a suggestion what other videos I can come up with, please feel free to leave one below. Thanks for watching, and I'll see you guys all on the next video. Peace.